In this video, we will learn about cash flow statements with a coffee business example. We will learn what is a cash flow statement, why it is needed, an example cash flow statement via the direct method. What is the indirect method of cash flow reporting? Example cash flow statement via the indirect method. So grab your curiosity and let's go. A cash flow statement reports on the inflows and outflows of cash over a specific period of time, like 1 year. It tells us about where the money is going, and sometimes the answer is just as dramatic as your bank account after holiday shopping. Why is a cash flow statement needed? Because other financial statements don't quite tell the full story of cash. Take, for example, the income statement. It's great for showing net income and profits. But net income and profits are not the same as cash in the bank. This is because, remember that an income statement reports on revenues and expenses, but just because a business earned revenue doesn't mean it actually got the cash yet. Same with expenses. Just because a company recorded an expense doesn't mean the money left the bank right away. Sometimes bills get paid later. So, based on the income statement, we'd have no clue whether the business is actually sitting on a pile of cash or just drowning in IOUs. That's where the cash flow statement comes in. Because when we say cash, we mean real, actual money in the bank, not promises. Because cash is what keeps a business alive. Let's look at an example cash flow statement. In a cash flow statement, cash inflows and outflows are categorized into one of three categories: operating cash flow, investing cash flow, and financing cash flow. Part 1. Operating cash flow. Let's say that by the end of a year, we had sales worth a steamy $70,000. But of course, running a business isn't just about sipping lattes and counting cash. We also had to make payments for coffee beans, rent, utilities, etc., totaling about, say, $30,000. This is cash out and is noted within brackets. The brackets indicate a negative value. So after these expenses were paid out, our net operating cash flow was $40,000. Part 2. Investing cash flow. Let's say that we spent $10,000 on the purchase of a brand new coffee-making machine. Buying equipment is considered an investment into the business, and this falls under investing cash flows. So our net investing cash flow is a negative $10,000. Part 3. Financing cash flow. Suppose we took out a long-term loan of $25,000, which would lead to cash inflow. Also, we happen to have paid out dividends of a total of $5,000 to all our shareholders. This is a cash outflow. Our net financing cash flow, then, would be $20,000. Putting it all together and adding up the three types of cash flows, we get the net cash flow for the year to be positive $50,000, meaning that this is the cash that was generated by the business through the course of the year. Let's assume that before we started the year, we had some starting cash, which was $10,000. Summing it all up, we get the new cash balance at the end of the year to be $50,000 plus $10,000 equaling $60,000. This is essentially what a cash flow statement looks like. This is a simple example. In real cash flow statements, you may see many more entries for various cash activities. We saw three categories of cash flows: operating, investing, and financing cash flows. Investors and lenders tend to consider operating cash flows as the most important section. That's because it indicates the cash that the business can generate from its actual sales. Not loans, not investments, just pure espresso shot cash generation. This matters because a business that can generate cash from its sales is better able to meet its obligations and invest in its growth. What we just saw was the direct method of reporting cash flow. Direct means every cash movement is noted directly with its respective category. However, most companies use the indirect method for reporting cash flow. In this method, the operating cash flow is derived from net income instead of listing the cash movements directly. This is easier because net income is already reported on the income statement. How is operating cash flow derived from net income? Net income contains both cash and non-cash items. So adjustments are made to net income to arrive at operating cash flow. Seemingly like a magic cauldron which takes in net income and spews out operating cash flow. Let's understand why companies use the indirect method. The indirect method is easier because it uses net income, which is already calculated while preparing the income statement. The direct method requires tracking cash transactions, which can get complex for large companies. Also, the indirect method of reporting is widely accepted by regulators such as the Securities and Exchange Commission, SEC. Let's look at an example of the indirect method of cash flow reporting based on net income. Suppose net income is $50,000 for our coffee business. The first adjustment we make is that we add depreciation to net income. Here's why. Depreciation is the decrease in value of an asset over time. For example, equipment for making fancy coffee concoctions will degrade over time. Depreciation is an implied expense that the business has to bear. Every year, a certain amount is noted as depreciation expense and subtracted from revenue in order to calculate net income. However, depreciation is not real cash leaving the business right away. Therefore, the depreciation that was previously taken out of net income needs to be added back to it if we want to get to cash flow numbers. So let's say our depreciation was $5,000. We add this amount to net income. Now our adjusted number is $55,000. The next adjustment is to subtract accounts receivable. This is money our customers owe to us, and it has not arrived in our bank yet. Accounts receivable are counted as part of net income, as this is money that the business has earned. However, this is not available as real cash yet. Therefore, it needs to be removed from net income to get closer to real cash numbers. Let's say we had accounts receivable of $20,000. This will be subtracted out of net income. Now our new adjusted number is $35,000. Our final adjustment is to add accounts payable. Accounts payable is the amount that our business is due to pay to someone. Therefore, when calculating net income, payables are subtracted from revenue. However, payables are due later, meaning cash has not left the bank yet. Therefore, we need to add payables back into net income to get to cash flow. Let's say that our accounts payable was $5,000. This will be added back to net income. Now, our new adjusted number is $40,000. This is the cash flow from operating activities. The number is the same whether found via the direct or indirect method. Note that the investing and financing cash flow representation remain the same between the direct and indirect methods. Combining our derived operating cash flow with our previously noted investing and financing cash flows gives us the following cash flow statement via the indirect method. The operating cash flow section shows the adjustments that were made to net income to derive the operating cash flows. These are just some of the many adjustments that are seen in real cash flow statements. The investing and financing cash flow sections remain the same. There we have it. Hopefully you enjoyed watching this video today. Please consider subscribing and like and share our video with others to spread the knowledge. Thank you for watching.